Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Thursday, March 2nd, 4:49 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market in an uptrend, short-term caution because of the fact that all five of the major indexes are trending below their downsloping 21-day exponential moving averages. That's the reason for the caution. We were on the brink of having a lot more reasons for caution early in the day when we broke below the 200-day moving average. But what the Fed taketh away, sometimes the Fed giveth. We had a big negative reversal on Bullard speak a couple of weeks ago. Today, a Fed dove came out and spoke, and the market had a pop higher, digested it for a while, and then looks like some short covering kicked in, and we took off on a nice run higher, going from a gap down of 0.5% to a positive close of almost 0.8%. So gap down, positive reversal, definitely a line in the sand day for the market, and we'll talk about that in a minute. Leaders still holding up okay. Medium term, one close below the 50-day moving average for the S&P 500, and then an undercut of the 200, and basically a close right on the 50 today. You could a point below. The SPY is actually slightly above the 50-day, but basically right on the 50-day. So some improvement there long term. All five of the indexes are above the 200-day moving average. Only the mid caps are clearly showing a trending slope higher. The other ones are flat to basically barely turning higher. We need to see a little bit more strength to get those pointed in the right direction. That would be northeast is where we want them pointing, and then any back test of those we want to hold, and that's kind of like we did today. So uh, definitely a positive day after as dismal as things have been lately. So as I said, what just happened? Gap down, positive reversal, definitely a line in the sand. That means anything that you own and the indexes, a positive reversal off of oversold puts a line in the sand. So we bounced. Was it just a little bit of short covering? Is it something that will have more strength? We gauge everything against today's lows. And if they give out, then this was just a very temporary bounce and we're headed lower. And the fact that it happened so close to the 200-day moving average for the NASDAQ 100 and the S&P would certainly be a huge negative. So to me, a clear line in the sand today with the upside reversal off of older oversold conditions. A lot of green at the finish. G6 up 0.7%, S&P up 0.76, NASDAQ 100 up 0.8, Dow led by a nice move up in a high-priced component, CRM, Salesforce. Dow led up 1.05%, mid-caps up 0.5%, Russell 2000 lagged up 0.2%. Global diversified 60/40 stock and bond up 0.24%, more lower prices for bonds, which means yields went higher. That throws a little bit of cold water on the rally today. We didn't get cooperation from the dollar. We didn't get cooperation from yields. So if those continue in the trend that we're going, wouldn't be surprised to see this rally fail quickly. We definitely need some help there. GROTECTION in-house, we're up 0.37% today. We'll talk about the portfolio, a buy and a sell that we made today, and take a look at the charts momentarily. Let's get right into it, including the tail of the tape, and we'll start off with the S&P 500. You can see, let me blow this up a little bit, make it a little bit clearer. Undercut of the 200-day moving average, that's the black line. We're showing 39.83 as the 50-day moving average, and a close rounded 39.82. So basically right on the 50-day moving average, just barely below the declining 8-day. This is our ultra short term indicator. We want to get it back above that first and then take a shot at the 21-day moving average. You can see what I've been looking for on a close. We saw it 2 or 3 times over the last for 4 sessions or so is that we would get a hookup during the day, we'd sell off into the close. The hookup in the stochastic from oversold conditions would fail. Right now, we got the hookup, then we want the cross, then we want to get out from oversold. At that should coincide with us getting back above the 80 EMA and testing the declining 21 EMA, which we've been underneath for 10 days now, I believe. We'll check it when we go to the tail of the tape. So there's the S&P 500. Let's go to the NASDAQ 100. Undercut reclaim of the 200-day coming up into the declining 8 and 21. They're very close to each other. Got the hook up on the stochastic from oversold. That's a positive. Let's go to the Dow, which had been the laggard, but not the last 2-3 sessions. The Dow reclaiming the 80 EMA today. So the first of the major indexes that we're reviewing here to get back above the 8 had the stochastic hook up and cross of the moving average. So a little bit further to recovery from a what have you done for me lately standpoint with the stochastic. Mid caps. This is basically right on, barely above the 21 EMA and 0.1% above the 80 EMA, also with the stochastic cross, hookup and cross of the moving average. So mid caps, which had been showing relative strength, didn't show it today, but the recent strength coupled with the move up uh, put us where we wanted to be. In other words, it's a first step to where we want to be, certainly. Stopping going down is always a good thing. Russell, this is actually a fourth straight close for small caps, believe it or not. And we're right below the 21, right on the ADMA. Got the stochastic set up there too. So good stuff from small caps. Note the relative strength over the last 2.5 weeks. Lag today, but again, um, nothing goes straight up or straight down in the market. This is definitely a good first step, and it's definitely, to me, reinforces the line in the sand for today. So we're starting something. We need to continue it. Let's go to the VIX, which also got on our side today with a move back below the 20 level and back below the 50 and 21-day moving averages. That's a tailwind for the bulls, something that did not cooperate. But if note the stochastic crossover in the dollar cooperating, but hooked back up today. Never got out of oversold or overbought territory. This is one of the other things that we need for a sustained rally is for the dollar to come off a little bit because of the inverse correlation that we've been seeing. It did close at the bottom of its range, but it did have a nasty gap up and a significant move up after a move down yesterday. So watching the 200-day moving average, watching the stochastic, watching the recent it hasn't made a higher high after last Friday, so at least we've got that going for us. How about the equal weighted index RSP versus S&P 500 up 0.8%, basically in line with um, with the market cap weighted index and QQEW better today than the market cap weighted index. You can see it here, and they both have the stochastic cross up also. So everybody rowing in the right direction there. I like to see that between the indexes. Now let's switch to bonds. Bonds down today. That means yields higher, although they did reverse and close at the top of their range, at least on the broad bond index here. Let's look at junk bonds. Positive on the day. These move more in line with stocks. LQD, corporate bond, also positive on the day. That's a good sign. And TLT down 0.89%, again at the bottom of its range. Did break below this 100 level here, and we'll go to the let's go to 0TNX, the 10-year. See if we closed above. Yeah, we did. We closed above 4% today. You can see the gap up here. So stocks rallying despite that, but not sure they're going to be able to rally far if this interest rate strength continues. And look how this is just plugging higher along the ADMA. 0TYX, the 30-year, also up 1.7%, breaking above this consolidation that it had here. we need these to come off. So again, note the stochastic cross. It's never a panacea unless it follows through to the direction that we want it to. In this case, we got right to the point of coming off of overbought and we spiked back up again. So mixed results on participation from bonds and from the dollar today. The VIX cooperated, and like I said, could be an oversold bounce, but it's day one of an attempted move off of the lows here, undercut reclaim of the 200. We've been oversold. We need to continue to come off oversold and see if we can mount any kind of a rally. GLD down, but not much considering how much the dollar was down. GDX up slightly, so fourth positive close in a row for gold stocks, and SLV down, not a surprise, can't get back up through and stay through the 200-day moving average. Bitcoin barely positive on the day, consolidating tightly. So those are the major indexes that we overcovered. Let's go to the tail of the tape. You can pause this if you want to read through the whole thing. I'll hit the highlights. Initial jobless claims in the morning down worse than expected, and they lowered last month's under 200,000 for 7 weeks in a row. This is not what the Jerome Powell wants to see, and this led the futures pre-market to morning lows. We struggled to recover off of that, and then the good news: 1:35 p.m. Fed Raphael Bostic. He's a non-voting member, but he came out with some dovish comments. Let's go back to the S&P 500 on a 5-minute chart and see if you can see where Mr. Bostic started to speak. So here's our gap down, working our way off the lows, put in a cup and handle. 1:35 p.m. Very clear. His comments hit the wire. The immediate knee-jerk reaction: sell off a higher high. That's what you want to see. So we attempted to sell off, and we couldn't break back down. We got above that 39.50 level, which has been critical after the undercut and hold of the 200-day moving average here at 39.40. We got up to above 39.80. 83 now. The slope of the 50-day moving average on the S&P is trending higher, and we undercut it, then rallied right up into it, closed basically again right at the 50-day moving average on the S&P 500. So that was the catalyst for at least today's short covering. We'll see what tomorrow brings. So the day count to +1 now, from 7 out of the last 9 down. We'll call this day 1 up. Down 10 days on the 80 EMA, 8 days on the 21 EMA. Good stuff on the undercut and recovery of the 200 and the 50-day moving average. Here you can see the sectors that are weak, the sectors that are strong. In-house today, on the undercut of the initial undercut of the 200-day moving average, and then a rally up, we got rid of some SPXL, took the loss on that, and when we started going higher, we bought First Solar, which had a great day yesterday. It was just going sideways today, pulling back right around this 195-ish area, dipping below it. We got in 3 separate 1% buys: 194-ish, 195-ish, and 196-ish. And it closed near the highs of the day. Second day higher high, that's always bullish. Heavy volume again, that's good. Really, they upped. Look at the projected EPS for 2024: $6 2023, $12 in 2024. That's 101% gain. Very clearly, this is the leader in solar stocks. They'd lagged for a while, but it broke out of this pretty nice flat base here. That's also a stage 1. So ideally, we want to get the best stocks. We want to get our money into them as close to a pivot as possible, or a low risk entry point. And if the market rights itself, it'll carry these higher, or they'll pull the indices higher. Lately, it's been the leading stocks, we've been saying this for a while, have been acting better than the indexes, and that's why we still had a reasonable amount of exposure on today, almost a 1.0 beta. So let me get back to the bottom line here. So yeah, we came in at a 0.98, left at 1.02. Bottom line: finally, 200-day undercut and reclaim oversold bounce puts in a line in the sand. So today's lows, very critical. Let's hit some tickers here, and then we will wrap it up. Uh, okay. Yesterday, Tesla uh, had their investor day, and it was underwhelming to say the least. The stock gap down, but part of the gap down, uh, or during not the gap down led over to another sector, the silicon carbide stocks, because they said they were hoping to use less in the next generation car that they're building uh, to cut costs. Well, it's 2 years down the road at least for this new next gen $25,000 car, and they're just because they say they're hoping they can do it doesn't mean that they can. But this trickled over in a brutal way to the silicon carbide stocks. Look at this on a 5-minute chart, AEHR. Massive gap down, was down over 30% at one point. Huge shakeout, slingshot back higher, and then it worked its way higher as the day went along, getting back above the 50-day moving average. Uh, we dodged bullets with these. We had been in some of these stocks. We got shaken out of them. Yesterday, it was painful to watch. AEHR up 8% after we had been shaken out under the 21-day moving average. Undercut reclaim of the 50-day for AEHR. The next one, ACLS. Another big gap down. Look at the 5-minute chart on this. This was down from 132 to 110. Huge gap down over the first 15 minutes, immediate recovery, and then sideways into the close. So this one came all the way down to, it basically touched its 40-week, or I'm sorry, its 50-day moving average or 10-week moving average, and all the way back up to reclaiming the 21-day by the end of the day. Some other stocks caught up in it. STM hovered, closed near the high of the day. ON gap down, touched the 50-day moving average and recovered. And those are really the four major stocks that are tied to silicon carbide. Wolf isn't a leader anymore. It gapped down. It's already below the 200-day moving average. So they closed near the highs of the day after some nasty shakeouts. Uh, and this just happens to growth investors at times. So the reason the Dow was up today is this nice cup and handle breakout on CRM, 323% above average volume. For such a large cap stock, it's $187 billion market cap, closed near the lows of its day, but a nice breakout, and it gave the software sector a nice shot in the arm today. Another one, OKTA, security stocks have been showing serious relative strength. We're in Pan W and looking to add to it. But you can see Okta further solidifying the strength in the group. If you look at this ETF Cyber, CIBR, you can see the relative strength that it's been showing. And as I mentioned, we're in Pan W had its high close after its gap up on day 7 after the gap up. In this market, if you're closing higher than your big gap up day, you're doing pretty damn good. And also note the blue line, meaning relative strength, at a new high. And one that did not work, DV, which is a shame because those are my initials. Gapped up nicely, was up over 10% at one point, reversed to close up 4.8%, still in its handle. And that's going to wrap it. So to summarize very quickly what we do here at Revere: participate in market uptrends, get out of the way in market downtrends. We use moving averages and uh, oversold, overbought indicators, declining trend lines, uh, shakeout patterns, basically to participate in the market when it's working higher. And we give the market the benefit of the doubt if we're above the 200-day moving average. And the reason for that is that if we're concerned about a bear market, you don't have to get concerned until you break below the 200-day moving average. All severe bear markets happen below the 200-day moving average. So this is our line in the sand for defensiveness. Usually, by the time, if you're in a strong uptrending market that's climbing a wall of worry, you usually top out about 12% above the 200-day moving average before you start selling off. So we track the percentage of what we're down, determine what type of a market we're in. Are we in a bull? Are we in a mild pullback, a correction, a mild correction, a bear market, a harsh correction? Are we recovering from a bear? And we've had expectations for our portfolios because of the rules that we follow for whether we're going to be in or whether we're going to be out. But the key thing is in the market, it's not how much you make, it's how much of that you can keep. And you do not want to get caught in a negative sequence of return scenarios in a severe bear market. 27.5% at the low last year. Our loss at its worst was a little over 12%, so less than half of what the market did. And now we've got the powder dry. We're still less. We still have over 50% cash, and we're ready for leading stocks to take this market higher. If that's what it is going, it wants to do, we'll be there for it. Email if you have a question, any questions about this, Don at revereasset.com, or my partner Dan Stewart, Dan at revereasset.com, or the phone is 855 Real Wealth. That's 855-732-5932. So once again, it's not how much you make in the market, it's how much of that you can keep. And with that, I'll wrap up Thursday, March 2nd. This is Don Vandenbord, just the facts, telling it like it is here at Revere. Thanks and have a great day.